searching for yields, and then the markets are exuberant. And when, after a few crises as we had in Latin America in the last 50 years or 60 years, we are champions in crisis. We had a lot of experiences in crisis. We know that when the real sector is not as strong, but the financial markets are in record highs, well, something to be concerned, because everybody will expect that the adjustment of asset prices in financial markets, and with all the consequences we all know. Even when there is low volatility in financial markets, but it's not necessarily good news in this context. No? Probably it's anticipating the storm, I don't know. But in fact, we feel that at some point the markets will adjust and the asset prices will adjust. I remember in the IMF meetings in October, Tobias Adrian showed a slide which title was the search for yield. The search for yield has gone too far. So I think that this has to be of our concern, because when financial markets, global financial markets collapse or at least adjust significantly, it has a very hard implications on small and open economies. Well, one good news in the world is that commodities prices are more stable. So that's part of the context in which we are also have to decide economic policy. That is the 3 or 4 main ingredients I think we have to take into account in order to understand the pressures on financial stability in small economies. Then the emerging economies, open and small particularly, are facing a challenging global scenario. No? As I was saying, it's an increasing globalization and interdependency. Volatility, perhaps not in financial markets right now, but in the global context and in political uncertainty, which is very volatile too. And we have to deal with a set of multiple objectives of economic policy. Financial stability is one point that allows us to reason in terms of we don't have only one mandate for central banks, we don't have only one objective in economic policy. Price stability is absolutely relevant, but as well, financial stability, the sustainability of public accounts, competitiveness, those are all 4 or 5 objectives that we have to deal with simultaneously, and we have to solve those simultaneously. So that's relevant to understand sometimes particular monetary or exchange rate or fiscal or financial measures that governments and central banks are deciding at every time, because they have to be understanding the whole set of objectives at the same time. And particularly related to financial stability, it's absolutely absurd to focus only on financial stability without seeing that in a context of macroeconomic stability. And this has to be faced with the consistency of macro policies, of course. Monetary policy, fiscal policy, income policy, financial policies have to be consistent. And also, given the volatility and uncertainty we have, risks are increasing, and then we have to have a strategy of managing risk. So these 3 pillars that we established for economic policy has this relatively new perspective, which is to incorporate the risk management perspective into economic policy. As well as firms or multinationals or domestic firms internalize the risk management approach, well, economic policy also has to internalize that. And sometimes that helps to explain why we make some decisions that could be costly in the short term, but it's absolutely needed to reduce costs in the medium and long term. That's that kind of insurance premium we pay in order to mitigate vulnerabilities, because risks are significant on an everyday basis, and we have to mitigate vulnerabilities. We have to be prepared to face when those risks are materialized, and sometimes that implies paying a macroeconomic insurance premium, let's say. For example, when we deal with interest rates, when we deal with money aggregates, when we deal with exchange rates, and so on. And one particular variable that I think that is crucial in order to understand all these processes in emerging economies is the expectations on the evolution of the US dollar, particularly in this US dollar influence zone. Because this expectation, in our opinion, have determined capital flows and portfolio changes that in general goes in the very same direction in countries like Uruguay, in which you can switch from domestic currency to foreign currency so easily. When the expectation was that the US dollar will be declining, for example, from the financial crisis until 2013 with the Bernanke tantrum, the capital flows essentially were moving towards emerging economies. Countries like ours receive significantly amount of capital inflows, not only in the form of FDI, but also with very low interest rates, but also in terms of short-term financial capitals. And that imposes significant challenges for macroeconomic policies, and particularly for price and financial stability. But when the expectation reversed, when Bernanke say, okay, perhaps there will be the time in which we will be reverting the monetary policy in the US, well, expectations on the evolution of the US dollar reversed, and rapidly capital flows reversed also. They stopped coming to emerging economies. In some cases, they even get back to the developed world. And all the challenges reversed too. So we have a very volatile perspective on that grounds. That's why, and after a couple of years, and with Trump winning the election in the US and making some comments related to that, he felt that the US dollar is quite strong because their friends are having problems in exporting to other regions of the world. Well, again, the expectations on the US dollar stabilized. So everybody who were thinking that the US dollar would be strengthening stopped or reversed that perspective. And again, capital flows was searching for yields in emerging economies. So there was a challenge for our macroeconomic landscapes in order to stabilize all these huge processes of capital inflows, outflows, inflows, derived from the expectation of weakening, strengthening, weakening the US dollars, which I think is the key variable. And I was saying that in our countries, not only capital inflows, but also decisions on portfolio changes of institutional investors. Because probably in our case, in quantitative terms, it's probably more important. We have a very tiny exchange rate market, for example. It's much more important the decisions that the pension funds, banks, insurance company made related to the currency composition of their assets than capital inflows themselves. So both are in the very same direction. When capital get into the country, there is a significant de-dollarization process of assets of all these institutional investors. When you have capital outflows, then you have a re-dollarizing process of these portfolios. And right now, again, we are having capital inflows, but mainly a de-dollarization again of institutional investors' portfolios. All those having enormous pressures on a very tiny spot markets we have in exchange rates. So there is a huge implication of volatile capital flows for macroeconomic and financial stability in small and open economies. Again, financial stability has to be seen in the context of macroeconomic stability. And we have one blessing, which is exchange rate flexibility. We took half a century to understand, to lose the fear of floating and to understand that our small countries can have financial backup enough in order to sustain or support exchange rate commitments. We have a flexible regime in terms of exchange rates. This flexibility acted as an automatic buffer to cushion against external shocks, and we have huge external shocks in a global and regional basis in the case of Uruguay. And they contribute to provide an adequate incentive structure in the economy. But this flexibility also came with market intervention by governments and central banks because, as I was saying, we are having a set of objectives that has to be solved simultaneously. And that's why the foreign exchange market intervention has been done in order to reduce excessive volatility, because all the landscape we pictured before implied a huge volatility. We have to reduce that because a too volatile exchange rate is not good news for decision making. And also to reduce currency appreciation or depreciation, depending in which period we were talking about, under alternative circumstances, so capital inflows out and de-dollarization of assets, capital outflows and re-dollarization of assets, and again, capital inflows and de-dollarization of assets. So in alternative circumstances, if there weren't market intervention by the central bank, that volatility would be bad news, because spot decisions were being conditioned on circumstantial processes and not fundamentals. It's costly to sterilize market intervention for sure, but it has to be done by balancing with other goals, such as low inflation and long-term competitiveness, because again, we have to be solving all these objectives simultaneously. In the process of market intervention, we have also a relevant process of international reserves accumulation, which allowed us to have a prudent use of those reserves when we had to, in the process of capital outflows or re-dollarization of assets, of portfolios, which, well, all this accumulation or prudent use of reserves has helped to stabilize flows in this matter. Well, policy challenges in the current global environment. There is excessive liquidity in financial markets. Again, the search for yield probably has gone too far, according to the IMF opinion and of our opinion too. We are very concerned about the exuberance of financial markets right now. There is the risk of a drastic adjustment of asset prices in financial markets. And there are also risks of capital flows, stop or reversals due to market expectations, which are very volatile, or that depends on political factors, or that depends on factors that are not essentially their fundamentals. There could be an excessive currency appreciation or depreciation pressures, according to the period we were talking about, that, in our opinion, that justifies enough the market intervention by central banks, mainly, in order to smooth these volatile pressures. Of course, a prudent monetary policy has to be done in a context of changing money demand, because the picture I made in terms of capital inflows, capital outflows, or re-dollarized or de-dollarized portfolios implies drastic changes in money demand on a very daily basis. So monetary policy has to be very accommodative to the significant changes in money demand. Of course, the prudential regulation and stability, the prudential regulation of the financial system is crucial on that grounds. We have to be very focused on how the financial system is working in these volatile periods. And also the perspective of systemic risks and developing and strengthening the stability committees. So all the agents of the financial safety net has to be coordinated in order to assess systemic risks and act with coordination facing those pressures. We also use, during all these years, a set of macroprudential instruments. In fact, we begin to work, and after a while, we name it macroprudential. And at some point, we were discussing, well, does macroprudential mean? No? But in fact, at the end of the day, we learned to somehow to put in order all the, a set of measures we were developing mainly from central banks, and we call them macroprudential instruments or tools in order to limit the exposure of the financial system to systemic risks. And that's why central banks in emerging economies have used capital and reserve requirements, countercyclical provisioning, caps on foreign exchange positions, all of them to limit potential imbalances derived from volatile capital flows to reduce systemic risk and to enhance financial resilience. Well, I have a couple of slides additionally related to the technological dynamics and additional challenges that central banks have related to cryptocurrencies, virtual currencies, and also in the analysis and regulation of financial markets, the challenges that comes from fintechs and on the markets which are increasingly organized through electronic platforms. But I think in order to keep time, as the moderator asked, I will skip that in depth. So my first presentation is like that.
Thank you, Mario. Thanks for this first presentation. Sorry, I'm saying first presentation in the sense that let me recall the usual rules of the games in such a situation, such as policy panel. We will try to do a first round of 15 minutes for each, and then we will try to do a second round, and then to the floor for some questions. Thanks for your insights. It was really useful to go ahead. Basically, the global financial cycles is a story of leaders and followers, of action and reaction. And so I think that we will go in depth with the following panelists. The second one is Ricardo Correa. Ricardo, the floor is yours. This is for you.
Perfect. First, I want to thank the Central Bank of Uruguay and Rich for inviting me to this fantastic conference. I've learned a lot today, and hopefully you'll learn a little bit from this policy panel. So I'm gonna, first I have to give you the usual disclaimer. It's at the bottom. I think I'm gonna give you a view that's slightly different than that of the governor. Hopefully that's interesting, and maybe we'll have a discussion about that. So I'm gonna talk a little bit about the global financial cycle and prudential regulations or instruments. I like to call them prudential because, I mean, this differentiation between macroprudential and microprudential sometimes is very ad hoc. So I call them prudential. Some could be structural and some could be cyclical. So the cyclical ones are more like the macroprudential policies. So I'm going to talk a little bit first about trends in international financing. And mostly I'm going to focus on the banking sector because the banking sector was one of the culprits during the global financial crisis. And so I want to show you where we stand in terms of the internationalization of financing through these intermediaries. Then I'm going to pose this question whether the global financial cycle has changed as we know it. And I'm going to show you some graphs, and maybe we can have a further discussion about this later. And then I'm going to suggest some link between the global financial cycle and prudential policies, and how recent prudential policies may have affected this global financial cycle. So let me start with some charts. So here, what I'm plotting in this graph is the blue line is what we call international claims. So this come from the BIS International Banking Statistics. So this is namely the sum of cross-border claims originated by banks that report to the banking systems that report to the BIS, and the local claims, so claims originated in local offices of global banks that are denominated in foreign currency. So in the case of a country X, if a bank has an office there and then it issues in a currency different from the local currency, that would be included in this series as well. So what I want to show you is a couple of things. One is there was a rapid increase in the internationalization of banking all the way to the global financial crisis. Part of this is because a lot of countries started reporting the statistics, but a lot of it is because indeed global banking became bigger in this in the 2000s, in late 1990s and 2000s. But after that, we either see a stagnation of global banking activity. So as you can see in the blue line, it's more or less relatively flat. Or if you divide global banking activity by global GDP, you see that there's actually a decline, quite a decline in the last 5-6 years. So the global financial system or global banking system is not growing. It's actually either remaining stable or compared to GDP, it's actually declining. So, and this is in a period where there was a lot of monetary stimulus because of the problems we face in different economies. Of course, I mean, this could be driven also from the demand side. So I'm not claiming that this is coming only from the supply side. And this is true also for emerging markets. So here, I'm showing two things. One, the blue line is the same international claims series that I showed you before, but these are claims on emerging markets. And then the red line is local claims originated by these global banks, but in domestic currency. So as you can see, I mean, there's a rapid increase leading up to the global financial crisis, but then there's a little bit more of activity until 2013, but then it's sort of stable. And still, I mean, if we look at in the aggregate, domestic financing for the world as a whole is more important than cross-border claims. So the blue line shows the amount of local claims that are originated across all the countries that the BIS collects, and the red line is just cross-border claims. And this is as a percent of GDP of the, in this case, is the whole world or the world covered by the BIS. So you can see that we're still dominated by local claims rather than cross-border claims originated by global banks. Again, the same thing for emerging markets, and in this case, I'm just showing Latin America. So there's also a rapid increase in the 2000s, but mostly in local claims. So credit increased quite a bit, and then it stabilized. For cross-border claims, it has remained more or less flat, the percent of GDP over the last since the early 2000s. So, so this is just a starting point. So this is where we stand in global banking. So let me go to one of the questions that was asked at the beginning about the global financial cycle, and just to give you a brief summary of what the literature says. I mean, the global financial cycle is something that several researchers have analyzed. One of the seminal papers is Ray, 2013, where as it was mentioned before, argues that this global financial cycle, if it influences global flows, is gonna affect the independence of monetary policy authorities, especially in small open economies. And so typically how they estimate the global financial cycle is there's a common factor in asset prices, and they have shown that that common factor is related to the VIX and to financial stress measures. And then there's another step where they analyze whether this global financial cycle or the VIX is related to monetary policy, and they discuss the channels through which this monetary policy may affect the global financial cycle. So this is just a starting point to analyze the global financial cycle. So let me show you more pictures where we're going to see how the global financial cycle relates to some measures of banking activity and bond issuance. So before that, let me compare the VIX with U.S. monetary policy. So if you look closely, so the VIX is in red, and the effective federal funds rate is in blue, and it's in black, and the effective federal funds rate coupled with the Wu and Xia shadow rate is in blue. So as you can see, there's sort of a correlation between the VIX and U.S. monetary policy rate, but I mean that correlation is sort of weak. And actually, at the end of the period, actually the correlation becomes negative. VIX goes down while the monetary policy rate after liftoff is going up. So one of the arguments is that you see these increases in capital flows, influenced by the global financial cycle, because there's an increase in leverage by large financial institutions that can lever themselves. So here what I'm plotting in green is the leverage of broker-dealers in the United States. I mean, that has been the measure that a lot of papers have used, starting with Adrian and Shin a few years ago. So you clearly see a correlation, negative correlation between the VIX. So if the VIX is low, you're going to see more leverage by the broker-dealers, and vice versa. So you see that the correlation is quite important up to the global financial crisis, but after that, that correlation is gone. So if you see the VIX goes down, but leverage also goes down for these broker-dealers substantially. So I'm going to come back to this because I think this is the result of prudential regulations that were implemented after the global financial crisis, and how that may affect fundamentally the global financial cycle. So now let's see whether the VIX, which is a proxy for the global financial cycle, is correlated in any way to lending, cross-border lending in US dollars, and bond issuance in US dollars. Because one of the concerns is that if there's appetite for risk-taking, or if monetary policy is loose in the United States, that may lead to an increase in capital flows, and especially to these financial intermediaries. And you do see that there's you see two things from this chart. One, bank lending in US dollars was more prominent prior to the crisis. I mean, bond issuance, or the growth in bond issuance, was more or less stable. But you see a switch after the global financial crisis. The growth in lending in US dollars actually goes down, all the way down to 0 at the end of the sample. But bond issuance, the growth in bond issuance, the green line remains positive. And so there's a switch between intermediation done through the global banking system and intermediation done through other intermediaries who hold these bonds. So this is for the whole world. We can do this for emerging markets as well. And you see a similar pattern, but at the end it's more striking that as volatility goes down, so as the VIX goes down, actually the increase in lending in dollars actually goes down quite a bit, while bond lending increase. And at the end of the tail end of the sample, actually there's an increase, which is correlated with an increase in monetary policy in the U.S., which goes the opposite way that you would expect. But part of it is because, I mean, the global economy is recovering, is growing at a more robust pace, and that may be leading, or that may be generating this increase in lending and in bond issuance at a time when policy rates in the U.S. are becoming are going higher. So I think people are starting to rethink a little bit this concept of the global financial cycle. The global financial cycle and these determinants may change over time, and that's what Avijay and the other co-authors have shown. Also, the quantitative effect of this global financial cycle in capital flows may not be as important, quantitatively important as previously estimated, and perhaps more important, and that's how I'm going to conclude my brief intervention, is that it's even if this global financial cycle has become less prominent, you can still have spillovers to different countries that could affect their economies. And those spillovers, I mean, this paper has shown that these spillovers may be stronger for those countries that are weaker or have more vulnerabilities in their financial sector. So that's something I'm going to address in the last part. So, so what do we do? So perhaps we have to think about interventions. But those interventions have to be justified. So we have to clearly think what the externalities are and how to try to solve those externalities or those inefficiencies and intervene in a way that's not going to distort the economy. So two things. On the countries that originate these flows, there have been many changes, especially in capital requirements and also in liquidity requirements, that may have affected the international exposure of these banks. Maybe that's good because, I mean, the path that we had before the crisis was not sustainable. So these new capital requirements have rationalized the global exposures of these banks, and that has made the system more resilient. And even the sensitivity of these global financial intermediaries to monetary policy may have changed as a result of these new prudential measures. And lastly, from the receiving side, I think there are several countries that have used prudential, both macro and micro-prudential policies to curtail the impact of capital flows, and in several cases they have been quite successful. So I think we have more policy tools, and that those policy tools may be useful in curtailing this global financial cycle if the global financial cycle is still what it is, or what it was before. So to conclude, the global financial cycle may depend on the structure and the resilience of the financial system at a given point in time. So it's important to keep track of where we are and what's driving that financial cycle. But more than that, is key that both advanced economies and emerging market economies keep their financial vulnerabilities in check, especially leverage, maturity transformation of these financial intermediaries, and currency mismatches. So I'm going to leave it there, and maybe we can have more later.
Thank you, Ricardo. We are building up our narrative. Schiller, in his presidential address, said that economics is a series of narratives. So our narratives of a global financial crisis, there was a dominant player, US, with his monetary policy. And Ricardo, it seems to me that you cast some doubt on this interpretation, but we can elaborate on this. And before to give the floor to Giovanni, let me say, President, that it's really easy to do the moderator here, because there are a series of very effective and kind lender of last resort that remember me all the mistakes that I am doing. For example, I've forgotten to recall that there is a co-organization with the Financial Stability and Development Network of the IDB. Thanks also for the co-organizers. And thanks for my lenders of last resort here in this floor. But in this room, it's natural to find out effective lender of last resort. Giovanni, the floor is yours. Now we have to.
So let me. Is on.
Okay.
Sound on, but
yes.
I hope you can hear me, but now it's on. Let me start by thanking all the organizers, so don't miss anybody, and whoever they are, for the kind invitation. It is a pleasure to be back here. And to specify that whatever I say today are my own views and do not necessarily represent those of the fund or its management or board. Sorry for the bureaucracy, but I have a family to support. So, when I was asked to sit on this panel, the organizers kindly sent a set of questions. So I tried to organize my presentation along those questions. There is going to be some plagiarizing from myself in the sense that tomorrow's presentation will be a lot about the same issue. So apologies if you see a couple of charts twice. So one question was, what are the spillovers from unconventional monetary policies? So the unprecedented expansionary conditions that we have seen since 2008 in the United States, but also in the Euro area and Japan and the UK to some extent. So from the core, there was a lot of liquidity, very low for long interest rates. And are these spillovers? I think that the implied questions are, are these spillover different from what we have witnessed in other monetary policy cycles when the primary instrument was the interest rate? And if you read the literature on this, it's very hard to come up with both from a theory standpoint and empirical standpoint, with a view that the elasticities were very different in terms of the effect of long-term rates on spillovers. But I think there is for sure at least one dimension of unconventional policy that lends itself to much larger spillovers, and is the time dimension. And when policy rates in the core countries reached the zero lower bound, monetary authorities started engaging in employing different strategies, in particular forward guidance, which essentially would promise to keep rates low for a very long time. And from that point of view, of course, now if you are a financial intermediary engaging in a carry trade, this becomes much safer. And the main risk in a carry is that your own home country authorities squeeze you on the short end, where you're short dollar, long reais, and the Fed tightens, and you take a bath. But if the Fed is telling you, look, for the next 5 years, the interest rate is going to be at zero, well, that's very reassuring. And so the positions that you can take are potentially much larger. So I thought there was one big difference. I think the second difference, and this is at the bottom of this slide, is what was the role of China. And I think relative to previous cycles, we had what the fund called decoupling. And decoupling was seen, at least in theory, as a good thing. So now we had two poles, not just one. And okay, the US was doing relatively poorly, so was Europe, so the entire Western world was doing poorly. But in China, they had plenty of fiscal room, and they did their fiscal stimulus, and China did relatively well already in 2009. And these supported aggregate demand in commodity countries, and in particular in Latin America. And from a real sector point of view, you would say this is a good thing. But the financial side didn't decouple. The role of the dollar remained very prevalent. And so now the monetary policy conditions that in the US were geared toward a very deep recession were completely out of sync with what small open economies and emerging markets needed. And to some extent, that's, you can say, well, it's the fault of the decoupling. If decoupling had not occurred, you would have had a real shock in sync with the United States. And so the monetary policy conditions that you would have needed would have been more in sync with those of the Fed. Is this a curse or a blessing? I don't know. But I think it's something that one has to think about as the real structure of the economy changes to some extent faster than the financial one. In terms of, and this goes back, I think, to both what the president and Ricardo said, in terms of what you want to do, the way I see it is that you need to have room for exchange rate flexibility as much as you can. And although I appreciate all that Hélène Rey has done, I think that the trilemma still applies. And the dilemma applies primarily when countries, for one reason or another, have a hard time letting the exchange rate move. And these are perfectly legitimate reasons in many, many cases. You can have foreign currency exposures in the financial sector. You can have foreign currency lending in the real economy. And so to have a financial structure and prudential regulation that creates a sector, a financial sector that can take exchange rate flexibility, I think is key in being able to deal with the, I don't like the word global financial cycle, but say changes in external financial conditions. Whether there is a cycle or not, we could debate. So how do you want to deal with this? Should it be, here I have our little IMF inside acronym. MOP is monetary policy and MAP is macroprudential. We also have MEP, that is microprudential. So should you use monetary policy? Well, I think that I was at the Banco Chile 2 weeks ago, and I was in the enviable position of being in between Claudio Borio and Lars Svensson in discussing whether you should lean against the wind with monetary policy. And I think that I was in the middle. Claudio says yes, Lars says never. And I think, however, even Claudio would agree that in small open economies, the answer is closer to Lars's, in the sense that when changes in monetary policy will potentially trigger massive capital flows, it's unclear that you can deal with changes in the external financial cycle by moving the interest rate. Now that said, this doesn't mean monetary policy should be blind to what happens abroad, but it should not be the first line of defense. So I think that a combination of capital flow measures and macroprudential policy is much more promising, although the effectiveness of many of these policies is uncertain and probably erodes over time. We know that it erodes over time with capital flow measures, and I think from an intellectual standpoint, I have to think that it would erode over time with macroprudential policies as well. And use exchange rate flexibility whenever possible, and this brings me back to the point I had before about building a structure in the financial sector that can take that. So the related question that we were asked is, should monetary policy lean or clean? And again, and whether should central banks care about financial stability? And I think the question of whether you should care about financial stability, it's an obvious yes. I think it's less obvious whether this is a job for monetary policy. And I think going back to some of the charts that I think Ricardo used, this was a slide I prepared for this discussion of Claudio's paper. So in blue, you have the financial cycle as estimated by Claudio and his BIS co-authors. Red, I think, is just the economic cycle, and in green is the real federal fund rate. And here you see that monetary policy is not necessarily a good tool to deal with the financial cycle, because although there are periods like in the mid to late 90s and early 2000s where the correlation is very clear, the correlation is much less clear in other periods. And another observation that is very interesting here is that until the 80s, when the regulation started, there was no financial cycle. And so this goes back to my first point. If you build a prudential regulation in a way that leads to a very stable financial sector, maybe you don't have the problem in the first place, or the problem is much less. So the trade-offs in using monetary policy to deal with financial stability are relatively obvious. You can stick to your Taylor rule or Taylor-like rule and focus on the traditional objectives of inflation and output stability. In that case, you do not have any welfare loss relative to your traditional rule, but maybe there are growing financial risks and potentially you have massive losses in case of a crisis. Or you could deviate a little bit and lean against the wind, which means you have immediate losses in terms of employment, but maybe you reduce the bubble, and with that, the probability of a crisis. And in a paper that we published a couple of years ago, we did a lot of simulations, and to get to a cost-benefit analysis that is in favor of leaning against the wind, you really need to use all the parameters in the model that are in favor of that choice. You can get there, and that's why in the IMF paper, we do not close the door against leaning. We are not as certain as Lars is, but in most cases, the cost-benefit analysis, it probably is against it. And one way to put it, it was as I asked the question, the following question that for the US I think is the right number, is would you put 2 million people out of a job because your banks are too levered? This is the question that you have for monetary policy if you want to deal with leverage using primarily the policy rate. Another question was, well, okay, if you don't want to use monetary policy and you are telling us that we should use macroprudential, who should do macroprudential? Should it be the central bank or should it be another independent authority? And I think here, again, the trade-offs are relatively transparent. So if you look at the experience of the UK during the crisis, in which I think on Thursday, the governor of the Bank of England said that Northern Rock had no problems, and the next day they essentially closed it. You see that the communication between the central bank and the then Financial Stability Authority was not exactly what it should have been. And I think for anybody that has worked in a bureaucracy, you know that once you don't have the same boss and the same mandate, communication is problematic. I mean, working at the fund, we have our sister institution across 19th Street. We are very friendly with them, but I'm sure that we have our own problems in communicating. And I think anybody that has worked in a central bank knows that even communicating between two different departments at times can be problematic. So there is a benefit of bringing the macroprudential authority within the central bank. And in many countries, frankly, the central bank is the only agency that has the expertise and the personnel to do the job. Now that said, there is a risk, and the risk is to murky the mandate of the central bank and the political independence that has been achieved thanks to that transparency. So, and I'll talk more about this tomorrow. One of the reasons that central bank independence has been possible is that there was a very clear target, the inflation, and a very transparent and monodimensional tool, the interest rate. And because of that, essentially, at least in advanced economies, politicians and the public opinion decided that, okay, the board is just a very smart computer. They have a DSG model spitting out what they need to do, and they applied it, and we can fully keep them accountable because we know what they are supposed to do. At the same time, this defends the actions of the central bank, because when they tighten and people scream bloody murder, the next year they can point to the inflation rate and show that it's right below the target. And so if they hadn't tightened, we would have been above. Once you introduce things like financial stability, which are much less measurable, this goes out of the window. So, I mean, the obvious question is there a too stable banking system? I mean, probably there is such a thing as a too stable banking system, but it becomes much harder for central bankers to defend their actions once they had to do multiple things. The Bank of England is trying, I think, to square the circle, and probably is maybe the state of the art at the moment, in which you have two boards within the same institution with some overlap, but where the majority of members of each board have only one mandate. So the two boards communicate through the members that overlap, but they are separate in their tasks. And I think the final question was, so what should be the design of macroprudential policies? And I would say the focus, in my view, should be on leverage rather than asset prices. We have seen historically, while it's true that many crises come after periods of asset exuberance, in particular real estate prices, once you look at the way this asset exuberance is funded, that's what really matters. So if you take the NASDAQ boom bust of late 90s, early 2000, yeah, there was a wealth effect in the United States and a very small recession that followed the crash, but nothing comparable to what happened in 2008, even if the destruction of wealth on impact in 2000 was much greater than what happened in 2008. The difference is that the people that were investing in the tech bubble had deep pockets and were not levered. And the people that were investing in housing and mortgage-backed securities didn't have deep pockets and were highly levered. So leverage is what really matters. And I have a picture here. This is across countries. On the horizontal axis is the change in GDP during the Great Recession, so between 2007 and 2009. And on the vertical axis is the change in the credit to GDP between 2000 and 2006. the size of the bubble shows the level of credit to GDP at the onset of the crisis. And you see that there is a clear correlation, negative correlation between how you did during the crisis and what was the size of the bubble and the speed of growth of the bubble. And this is just to point, the leverage matters, I'm sure you know before. The other point is that I think the objective of macro-prudential policy, there are two objectives essentially. One is building buffer from when the bust comes. The other is trying to mitigate the boom. The empirical evidence so far shows that it's easier to do the first than the second. I think Rafa could talk about the dynamic provisioning in Spain. If you look at the experience with dynamic provisioning, there is no question that there was a nice war chest, to some extent, for the Spanish authorities when the crisis came that mitigated the impact, the fiscal impact of the crisis. But it's unclear that dynamic provisioning really slowed down the real estate boom and the mortgage boom before the crisis. And in many other countries, the effects look rather similar. And I think I'm done. Thank you.
Giovanni, thank you very much. Time. Huh? A series of insights. This is third steps in our narratives. It's becoming more complex and fascinating. Giovanni cast out, is there a global financial cycles? And Giovanni also suggests that could be one more player, China. And personally, I'm wondering if we have also to focus not just on US monetary policy, but also on US regulation and supervision, perhaps. But now, last but not least, our four panelists. Graciela, perfect. The floor is yours. Okay. Okay. Is this?
Yeah.
Right.
Can you open up? And ver.
The major land of last resort. ¿Dónde estás? There is nothing. Control L.
Ah, perfect. Okay.
International Control L.
Okay.
Sorry.
Thank you very much. First of all, I want to thank the Central Bank of Uruguay and Reach to create this forum for new ideas. Really, it gave, this is my third day here, so I got a lot of food for thought. But let me tell you that that's not the only food that I got. I also got food for the soul, and I've been enjoying all the steaks and asados, etc. So I have gained some weight though. So that's the bad shock. Anyway, what I would like to do is most of the focus here among the panelists was in the short run. So we were looking at the global cycle, we were doing at the crisis in the United States and how it's spread out and the challenges of emerging markets in this type of situation. I want to go a little bit farther. Yesterday I talked about 200 years of histories of international capital issuance and booms and busts. Don't worry, I'm not going to go that those 200 years, but I would like to look a little bit more, to look at, and especially all emerging markets in the past, not just in the 1990s, but also look at earlier periods and see what are the trade-offs of different type of policies. Okay, so I'm going to move and I'm going to walk because I have some graphs and I want to tell where I am. Okay, so of course the crisis in the United States has created a lot of demand to try to understand what this crises are all about, what happens when the financial center has a panic, okay, how it affects the rest of the world, okay. And in general, many have reassessed the idea that it's not domestic fundamentals that are triggering these booms and the busts, but it's the global financial center that is doing this. And so that's why this literature of the global cycle has appeared and has been increasing dramatically. Okay. Some have argued that now with this global cycle, okay, unless we have capital controls, okay, we cannot have independent monetary policies, and so the trilemma has become a dilemma, okay, and we need to have a managed capital account, okay. And in that sense, capital flows, okay, controls on capital flows have become more fashionable, even at the IMF, okay, and they are now part of a large toolkit of macroprudential regulations, okay. So the belief is that cyclical monetary policy in the financial centers is at the core of all these booms and busts, not domestic fundamentals, okay? And this has created some problems in the periphery, okay? And we talk about macroeconomic instability, about these large capital inflows, okay, that lead to expansionary monetary policy, inflationary pressures, all these complaints, okay, real exchange rate appreciation, current account deficits, and then the bust comes, okay? And then you have capital flow reversals and large and real nominal depreciations. And the question is what you do. And well, we have a toolkit. We can do monetary policy, we can do fiscal policy, or this macroprudential regulation toolkit. Although we have talked a lot about the global cycle, as Ricardo has mentioned, and also Giovanni has talked about, it's unclear, okay, whether the global financial cycle can explain all these capital flows to the periphery. In a particular paper that was presented at the beginning of November in the annual research conference at the IMF, okay, Cerruti, Claessens, and Rose present a paper in which really the global cycle cannot explains very little, at the most 25%, okay, of all the capital flows, okay, to the rest of the world. So this puts, again, the discussion of what to do with monetary policy. If the global cycle cannot explain all these capital flows or can explain very little, now we, again, have monetary policy. The problem is that even if we can have independent monetary policy, okay, with floating exchange rates, it is impossible for monetary policy to help to achieve all these different targets that the central bank might have, okay? We have a real target, okay? And for example, Giovanni has mentioned or has said that maybe the monetary policy should be focusing on the real target alone and leave for financial stability other type of tools, okay? The trade-offs can be between, for monetary policy to do both things, maybe really daunting, okay? Because interest rates increases to affect output may worsen financial stability, and by increasing fragility of the banks and triggering a lot of capital flows. So perhaps a combination of monetary policy triggering these two different goals may create more instability in the system. So we need to try to find some other tools. Fiscal policy cannot respond, okay, to these changes in environments, on global environments. You cannot react fast enough with fiscal policy, okay? But of course, if you have a war chest, okay, you're going to do better, okay, in times of crisis. So, I'm sorry. So now, okay, the debate is about macro prudential regulation, another tool that we need to try to reach, okay, financial stability. And so the question is that all these policies are designed to mitigate, okay, the financial stability associated with capital inflows. What are these policies? Most of these policies are applied to the regulated domestic financial sector. So they are applied to the banks, okay? And what the policies are all about? Well, foreign exchange related prudential regulations, okay? For example, limits on banks to have an open foreign exchange position as proportion of, let's say, their capital, or limit on banks the lending in foreign currencies, okay? There are other type of prudential regulations, for example, maximum loan to value of the asset purchase, limits on domestic credit, central limits on loan concentration, for example, target the real estate market, and as many of you mentioned, these dynamic loan loss provisions, okay, that have been applied in a variety of countries. The problem is, okay, that these type of measures can do little good on to play restrictions on domestic lenders if foreign lenders, okay, can enter the market, okay, and operate without restrictions. Similarly, if you have restrictions on domestic currency borrowing by residents, okay, they are going to be less effective if, for example, banks can go to the offshore, okay, and okay, borrow in foreign currency. So in order for macroprudential regulations to work, you need to introduce capital controls. Okay, and now we need to look a little bit at the effect of capital controls. Okay, and I want to raise some cautionary tale about introducing or looking at the trade-offs, okay, of introducing capital controls on macro-prudential regulations. If you're still looking a little bit at the type of measures that have been adopted and that you look that they are being studied, like control on credit growth or control on credit in a different of sectors in the economy, this looks much like financial repression, okay? And although financial repression and capital controls can contain some of the booms, and still, okay, the evidence is not so clear that they can contain the volume of the booms, what I want to bring about is the effects of this, capital controls on the quality of institutions. Okay, so there is extended literature on in finance about the effects of financial globalization on quality of institutions. For example, Rajan and Singales talk about well-established firms. Well, well-established firms can benefit during financial repression because they have the collateral, they have the reputation, they can get easy access to domestic credit. Okay, so reducing, okay, going into globalization, doing reforms in the financial sector, okay, is going to reduce the importance of that collateral on the reputation. And, if they have financial globalization, what they claim is that with cross-border flows, these incumbent firms are willing to make all these changes in institutions, okay, because now they have access to funds at lower cost. Also, financial globalization is mentioned that can reduce the importance of twin agency problems. That is the incentive of governments and corporate insiders, okay, to expropriate outside investors. In general, when you open up and the domestic resident is not linked completely to the financial market in the domestic country, and they can choose for an exit, okay, this is going to trigger, okay, new changes in institutions in these countries. So reversals in financial globalization may undo these reforms, okay? And so this is a trade-off that we need to pay attention to, because this is going to bring new distortions in the economy, okay? I did some work in the past with Sergio Smukler looking at the effects of financial globalization, whether changes in institutions, the quality of institutions improves before financial globalization, or financial globalization, okay, precedes, okay, the change in institutions. And we'll look at a certain number of indicators. Here I have whether, for example, we were looking at the improvement in law and order. We were looking at whether there was an enforcement in insider trading laws, okay, before or after financial globalization. And what you find is that before financial globalization, okay, what you find is that changes in institutions only occur, okay, after financial globalization is implemented, okay? And here we are looking at the beginning of liberalization and then full liberalization. And what you find is that from when you start partial liberalization and then institutions start to improve, okay, and when the process is completed, now we are dealing with much better institutions. We also, now we take for granted that central banks, okay, in the emerging periphery, okay, are autonomous, okay, but this was not the case in the past, okay. Here you have information on central bank independence, okay, and what you see is that central bank independence, the index, larger index is because you have more central bank independence. What you find is that central bank independence occur later on after, okay, financial deregulation and the opening of the capital account of these countries, okay. Another issue that is important to remember is that monetary policy has changed too. Before with financial repression and now with financial globalization. In the old days, there was a monetary policy in developing countries was mostly procyclical. So hiking interest rates when you were in a recession and lowering interest rate when you were in a boom. So expanding the size of the cycle. Okay. In more recent times, most developing countries now follow a counter-cyclical monetary policy, so they are trying to stabilize the real cycle. Okay. And so Weg and Bulletin have done some work on this issue, and they say that in general, as many emerging markets mature by undertaking market-friendly reforms and having better institutions, now they don't fear, okay, having floating exchange rate regimes, and this allows them to follow more counter-cyclical monetary policies. Okay. Okay. I also looked, in general, when you're trying to assess, okay, the role of different rules, okay, and the distortions that might bring, you need to really look at a longer episode. You need to look at the episode of financial repression, you have to look at the episode of globalization, and see what monetary policy looks like, what happens with institutions, etc. What happens with monetary growth, what happens with the credibility of the central bank. So here I'm not going to go over the numbers, but in general, okay, what you observe is that this is I'm looking at the money base of these developing countries, and in general you see that the growth rate, okay, on average on money base is much smaller during financial globalization, even though, okay, they bring capital, there are capital inflows, and as a result they accumulate reserves, and money base starts increasing. What happens during financial repression is that money growth is not driven by the changes in reserves, but is driven by lending to the government, okay, or lending to some sectors in the economy, okay. And in these episodes that we now don't remember so much, inflation was very high, okay. So I also wanted to examine whether credibility changes, okay? The credibility of the central bank changes from episodes of financial repression to episodes of financial globalization. And so in order to examine central bank's credibility, I follow Sargent and Surico in a paper that was published in the AER in 2011. And in that paper, they are looking at low frequency correlations between money growth and inflation for the United States. And they look at several episodes during an interval from 1900 to 2005. And the question that they had was whether, okay, quantity theory of money works. Okay, so whether you have growth rate of 100% in money, whether inflation increases in the same amount. And what they do when they divide the sample into a variety of episodes, sometimes what they find is that this, in fact, the quantity theory of money works, okay? But in other episodes, what you find is the larger growth in money doesn't trigger inflation, and the relationship between inflation, okay, and money growth is negative, okay, or lower than 1. Okay, and so the question that they ask is what triggers these changes in slopes? And so they estimate a dynamic stochastic general equilibrium model with a variety of exogenous shocks and monetary policy rules, and examine what happened with whether they can explain these changes in parameters in the relationship between money growth, okay, and inflation. And what they find is that if the central bank has, even if now the central bank is inflating, okay, if they are credible, okay, and they are expecting that the central bank is going to reverse this type of policy and is going to follow a more contractionary monetary policy, the relationship between, okay, money growth and inflation is negative because of the credibility of the central bank. And you can think a little bit about the United States, okay, that inflation has not grown, yes, 1 second, and the inflation has declined. So here I'm just giving you these plots, and here you can see, for example, Colombia, okay, the relationship between money and growth and inflation was positive during the episode of financial repression, and it became negative afterwards. Okay, so this tells us a little bit about the gaining credibility, okay, in episodes of financial globalization. Okay, so just some reflections. With globalization, policymakers have to pay attention to the financial global cycle or whatever, or the capital flows and monetary policy in the financial center. As everybody coincided here, monetary policy cannot do this role. There are other roles that the central bank has to do. And the question is whether capital controls and macroprudential regulations will do the job. Here I'm not saying that we don't have to apply certain measures, but I just want to remind you of the trade-offs, okay, of financial repression and non-financial repression and the effect of the institutions. And remember that these distortions can have very persistent effects. So we need to be aware, okay, of these distortions and take those measures accordingly. So thank you.
Thank you, Garcia. Thank you so much. In the 4th chapter, we completely destroyed the narratives that we used to start. So I have an idea. We can merge the Q&A with the second tour. So please, question from the floor, if any. Is there a, okay?
Very useful.
Question 4?
Actually, I'm gonna go for different speakers. It was very useful. Regarding to the cycle, there is an identification problem that we need to solve. It can come from external factors or local ones. And regarding to the global financial cycle and how to manage it when you need to put this into practice, then we are organizing something like the following. I think the foreign conditions should be acting as a foreign context, but it has to be materialized in the local economy. So we need to look for variables that tell us about idiosyncrasies like local decisions, regulations, or changes in the markets that are not fully related to foreign conditions. This is the first lesson. The second one is we should remember that, for instance, the countercyclical capital buffer is designed to manage credit-originated booms. And regarding to that, we cannot solve foreign exposure by limiting the countercyclical capital buffer or by activating it. So regarding to that, it's just I wonder, this is a kind of a question. In the countercyclical capital buffer that is proposed by Basel, we need to take into account total credit. But it's difficult even for banks to include or to incorporate an externality from other banks' credit extensions. And it's more difficult to incorporate an externality that is not even cost in the local banking system, like the debt that is acquired from abroad from firms. So how to manage that is something that is still a problem. And the other one is regarding to how's the cycle now. It could be two hypotheses. One of them is that volatility, and in a longer type of cycle, and the other one could be that we are facing shorter financial cycles. I still don't know what is the alternative, and probably you may know better. And the final one regarding to yeah, okay. is the final one. Is regarding to the last presentation. There are problems when you apply policies and you can get around, like foreign issues or foreign exposure, but there are solutions as well. So you can oblige foreign banks to issue local capital, this is one of them. And the other one is you can limit foreign exposure, like in Chile, 0 in terms of the exposure in banks. So how does it fit in the analysis?
Thank you very much, and thanks for your passion for my crude sense of humor. You and you.
And two questions. The first one is that when you have a domestic financial cycle, you always think of the domestic financial safety stability net in order to help you answer to that financial cycle. Yet we are talking about a global financial cycle and no mention to the global financial stability net has been said. So I wonder what are your thoughts on the role of international institutions on this. And the second one is the thing of whether we should focus on asset prices or leverage. And coming from Uruguay, I have this impression that of course you have to look to leverage, but sometimes you might get a large effect on financial stability without much large change in prices, asset prices, without high leveraging in the financial sector. And so, for example, Mario has co-authored a paper in which the effect of the region appreciates domestic assets without any participation of leverage on the role. And if you believe, as many in emerging markets do, and some papers in the past workshop inferred that there are externalities from the external sector to the growth rate, then you might want to be careful and look at asset prices. And in that line of defense, maybe the exchange rate is the first defense.
Thank you. Rafael?
I only have one question, which is about international policy coordination. This is for Mario or Giovanni. The mandates of the central banks are purely domestic, and nevertheless, their actions go beyond the borders of the nations. So in the end, what we have is a kind of a non-cooperative equilibrium in which there may be some suboptimal outcomes. So I remember Raghu Rajan forcefully arguing this point about US monetary policy when he was governor of the Reserve Bank of India, and of course he got nothing from all these complaints. So my question is, should we abandon all hope for having some more sort of cooperative outcome in this kind of both monetary or macroprudential policies?
Thank you, Rafael. Is there any other question? Please, thank you.
Thank you very much. So first of all, let me put the IDB T-shirt and thank Rich and Banco Central of Uruguay for allowing the bank, and in particular the Financial Stability and Development Network, to be part of this very nice event. We're happy to co-organize and hope that we continue like that in the future. Okay, so I'm trying to be very quick. For Governor Vergara, I cannot help noticing that you did not mention at all capital controls. So I'd like to know the views, why in practice you have not considered that as a tool, and if so, why? Or why not, as a way to probably complement or substitute maybe macroprudential policies. Why is it that you haven't used them? So Ricardo, I found very interesting the presentation, very surprising, the almost flat line for Latin America, the red one, meaning that we didn't experience any boom. But you focus on banks here, right? You leave corporates aside, and that has been a big debate. I'd like to know your views there, and if you think that macroprudential policy should be tailored differently for this case. Giovanni, I like the way you kind of like lean against the wind, of using lean against the wind for small open economies. Now, the BIS has been, in my very personal view, has been recognizing that and moving more towards a position of these economies cannot do lean against the wind, they should probably coordinate, right? How realistic that do you think that can be? And finally, for Graciela, you did mention that fiscal policy is not in the toolkit, if I understood correctly, at least not in the first line of defense, but it can certainly help, right? I mean, at least it can do no harm if we try not to be as pro-cyclical as government have been. So that.
Thank you. Thank you. Okay. So I think that we have a series of open questions. Let me add one more, given that this open question is a question for Mario. You know, in Europe, I think not only Europe, there are a couple of challenges for the central bankers. One, the main one is cash. In some countries, it's too much, as Italy or Greece. In other countries, really scarce, as Sweden. On the other side of the story, there are the cryptocurrencies challenges or threat, I don't know, which is the central banker reaction respect to these two extremes. On one side, the physical coin, and the other sides, the virtual one. Is there the possibility to have in the future a central bank digital currencies and issuing? Let me just propose to change. So first Giovanni, then Ricardo, then Graciela, and finally Mario. Giovanni?
So I think I had about 2.5 questions, maybe 3. On assets versus leverage, I think you have a point. If you believe that there are frictions other than those related to credit and default that work through the price of financial or real assets, then asset price booms in themselves become an issue. My point was more a positive, I mean, was a normative one based on positive observations. That is, typically when we have seen asset crashes that did not involve leverage, we have not seen massive real effects. One of the channels through which exchange rate crashes become contractionary is currency mismatches. But that is sort of a, then in that case, the price of the exchange rate becomes very relevant for positions that are essentially dead positions. And when you do not have mismatches, an exchange rate crisis typically is pro-cyclical. Think about ERM realignments in the 80s and 90s in Europe, which, you know, Italy or the UK would depreciate, and it would create a mini boom in the economy, which is the opposite of what happens in an emerging market. And typically, this is because of currency mismatches in the financial sector. So I'm with you, but at least historically, we have seen the association of negative real effects with leverage. So on Rafa's question on international cooperation, and I'll bring together the global safety net with this. So I think the old-style international economists would tell you, well, exchange rate flexibility will insulate you. And so, yeah, there are spillovers, but you don't need to cooperate, because if you let exchange rate adjust fully, you shouldn't care about anybody else's monetary policy. I think that's an extreme view, of course, it's a caricature, and you will always have some degree of spillover. I think the difficulty that Raghu had was that it's not that Ben Bernanke was not sympathetic to the problems of India. It's that he has a constituency and a mandate. And unless you change that mandate, it's very hard to convince a central bank that it should do something else. And it's very hard to convince a hard currency issuer central bank that their policy is beneficial to themselves when they deviate from a purely domestically objective to help a third country. And over the medium run, you had to say, well, look, you're going to get all this global stability from your longer horizon, and this will pay you back. And there was all this jargon about a spillback. So there are spillovers and then spillback. So if you damage India, then it's going to come back. And I think that Bernanke replied, yeah, we are completely aware of the spillback, and of those, we will take into account. So when there is a spillback, it's not an issue of cooperation, it's just you're maximizing your own utility, you just take into account what are the relationships. I think that I wouldn't lose hope. I mean, we have had episodes in the past, the Plaza Accord. One can have different judgments of the Plaza Accord. Some people think created the financial crisis in Japan, but the Plaza Accord was one example of international cooperation on the monetary policy front to realign exchange rates. So it can happen. I think that it did happen during the crisis, in which you had major central bank opening swap lines with smaller ones, and there was a clear attempt at cooperation. So I think that when things are dire, cooperation emerges. In tranquil times, I think it's a little bit harder. But hope should never be abandoned.
Thank you.
So I'm going to address Andres' question, and probably it's also related to other questions that were raised earlier. So what do you do with the private, non-bank private sector? So you can control the banks, you can control that what they're doing, but you cannot do anything about the firms that are borrowing from external sources. So, I mean, one way to do it is, I mean, you do observe what the banks are doing, your domestic banks, and those banks have connections to those firms as well. So if you have a firm that's borrowing heavily in foreign currency, I mean, tell your banks, if you're lending to that firm, that's going to be a risk to you. So capture those exposures that are going to try to internalize the externality of perhaps over borrowing by these firms by focusing on the banks that are also lending to those firms and try to make them more resilient and ask them either to set provisions aside for those particular exposures or try to limit those exposures. And in my graphs, I do show that bank lending went down, but bond issuance didn't go up dramatically. I mean, there was some substitution effect right after the crisis, but bond issuance by emerging market borrowers is not completely out of whack with the history. So it's not that there was a big substitution and we have a rapid increase in bond issuance by emerging market issuers. It's a problem because of the currency mismatches, but I mean, those currency mismatches is what policymakers have to focus on, how to control those policy mismatches when you don't have direct control. Maybe in some jurisdictions there's direct control over those currency mismatches by firms. In other cases, you would have to act indirectly through the banking sector, which is related to your CCYB question. I mean, you can control the capital requirements domestically, but you cannot control the flows from outside. But you can control what your banks are lending to those firms as well. So maybe that may mitigate that effect.
Thank you, Ricardo. Graciela.
I would like to talk about international cooperation. When you have a crash and I want to emphasize the problem of the collapse in liquidity. And when there is a collapse in liquidity, immediately the developing countries suffer dramatically. There is a big depreciation. They have capital outflows. They have liability dollarization. So this problem triggers a banking crisis. And of course, there is a big collapse in economic activity. It is, at this point, I think we need to emphasize, and I agree with you, it's at the times of crisis, we should do something, okay, to smooth out, okay, this big shock. And the idea is, I don't think that it should be central banks so much, but international institutions should start having these programs of providing international liquidity, so to smooth out the effects of liquidity, and create a program such that they can access, that countries who are willing to enter into this type of agreements, and that doesn't have so that at the same time that they are not being signaled as having a major financial problem. So it's at that time that we need to have these cooperations, and the international one, the IMF should be perhaps one of these institutions dealing with these problems. Having said that, I just want to mention that I have studied cycles over 200 years, and international capital flow cycles, the booms and the busts, have declined. I compared those cycles with the cycles during the first episode of financial globalization, and the bonanzas were much more dramatic, okay, in that episode, and the busts were much more dramatic because when the crisis developed, okay, there was lack of liquidity, okay, and basically all the developing world defaulted. This was for the cycles, like the cycle that we have seen before and after 2008, okay, in which the cycle in capital flows was around a panic in the financial center. So as a result, there was a collapse in economic activity because of this collapse, a financial crisis in the financial center, economic activity in the developing world collapse, in the world economy collapse. What we have seen since the 1970s is that when there is a crisis, all these cycles in the financial center are smaller. There is cyclical, counter-cyclical monetary policy that in the financial center that is much more very non-linear, because when there are crises around the world or other capital flow cycles with no problems in the financial center, monetary policy doesn't change much. But when there is around the panic in the financial center, monetary policy becomes highly counter-cyclical, increasing very rapidly interest rates as you go to the peak, and then reducing interest rates and easing liquidity in the bust. And what we have seen is that in the bust, emerging economies can borrow, okay, substantially more than they did in the previous episode, in which the central bank couldn't do any monetary policy because it was in the gold standard. The interesting thing is that with no liquidity after in the bust, or with a lot of liquidity now, okay, we still have a collapse in economic activity. So the question is that maybe we need to rethink about this letting countries deleverage in the bust, okay?
Thank you very much indeed. Mario?
Well, as you asked prior to the panel that we should enjoy the panel, that's what I do that now. First, on Rafael's question about international coordination, I will take the perspective that Enrique Iglesias has, since we are in the conference room named after Enrique Iglesias. I will honor that. And he's quite emphatic in the way that nowadays the whole coordinating system that emerged in Bretton Woods is probably in the worst of their times. The UN is not playing the role it's supposed to play. The WTO is not playing the role. The IMF is not playing the role. The World Bank is not playing the role. So they emphasizes the idea that all these international institutions have weakened significantly in the last decade at least. When you add other ingredients to that perspective, it's essentially reinforcing that perspective. For example, when you have the President Trump and powerful people in the United States suggesting that the US should get out of coordinating institutions such as Basel. No? So in terms of international coordination, I'm very, very skeptical. The other question related to capital controls, I would say two things. First, I really dislike the use of the term capital controls by referring to what we were doing in recent years. Because capital controls, in my perspective, reminds in the 60s when you have capital flows banned, forbidden. That's why when someone puts the physical dollars in a bag and make cross-border, we call them capital flight instead of capital flows, because they were fleeing from the cage they were supposed to be. So I think that it was unfortunate for the IMF to use the term capital controls for the measures that we were developing in recent years, and I think that it was good also for the IMF when they switched the just give me the time. You didn't like that I said that the IMF is not playing the role, and that's no, and that's what I think that is very positive.
Can you follow? Because it seems to me that the audience is increasing. So if you follow, unfortunately, we have no time.
No, that's why I think that it's fortunate for the IMF to switch the term capital controls to capital flows management measures. Because they are not the same. They are not the same. Because I agree with the idea of capital controls and financial repression, but then I was thinking in the 60s or 70s. But that's not, when I think what's happening in the last 6, 7, 8 years, is the situation is very, very different. Mainly because most of the measures are not measures like forbidden things, banning things, but trying to restructure incentives, which are costly because they were market friendly. So you pay a cost in order to try to restructure the incentives of capital flows. On that grounds, that's what I didn't mention capital controls, but we used capital flows measurement management measures. For example, a lot of central banks in Latin America use, for example, marginal reserve requirements. They were not average reserve requirements were thought in terms of monetary policy, but marginal reserve requirements were thought in terms of capital flows. When you impose a higher reserve requirement for new deposits, is that you were trying to reduce incentive for new deposits, for capital inflows on deposits. Similar to that, we use, we call it immobilized funds for non-residents when they buy government and central bank notes or bonds. So it was in Uruguay was the very first measure discriminating residents and non-residents since the 70s. It was a capital flow management measure. So we were trying also to impose a cost for foreigners to buy government bonds, trying to reduce the incentive for carry trade and stuff like that. So we used that. But I wanted to add, related to that, and also referring to what Graciela was saying, is that we use that on a transitory basis, a temporary basis. Because as soon as conditions reversed, most of those measures were dismantled. So that's not in the perspective of having capital controls and financial repression forever or for the long term. But we use very temporary these kind of measures, and as soon as financial conditions reversed, those measures were also dismantled. And I want to take the chance of that question as an excuse for adding one comment related to what is microprudential policies, macroprudential policies. I really disagree, or a friend of mine says in the terms of, I don't have the pleasure to agree with the perspective of having micro and macro policies. Because when you have micro and macro policies, then you can discuss, for example, as Giovanni was suggesting, the institutional side, how you organize institutions in order to develop micro and macro prudential policies, because you clearly allocate responsibilities. You have different mandates, and then you can allocate responsibilities, and then in the accountability side, it's clear who should respond to what. But I think that when you see all the list of the macroeconomic tools, most of them are micro tools, and essentially are using the very same tools that the micro-prudential policy uses to. For example, in terms of banks' capital, it's not clear that you might have two different authorities, one micro and the other macro-prudential, telling the very same bank what to do with the very same capital, trying to fulfill alternative objectives. So that's not, it makes no sense from the organizational standpoint. That's why I prefer to see that as a prudential regulation as a whole. That's why you need only one authority which is responsible for that has to incorporate both perspectives, the micro and the macro prudential perspective. But how to deal with different objectives within the macro, it's not a new thing. The macro perspective was not born during the financial crisis. because from the conceptual standpoint, the fact that the regulator has to deal with systemic risk was already well settled. No, there's not only the representation of an informed deposit, but the investors, but also the preserving the systemic functioning of the financial system. So from the conceptual standpoint, it's not that new. Probably the focus is new because with the global financial crisis, well, the systemic functioning of the system was key in order to understand the crisis. But again, that's why I don't like to have micro-prudential and macro-prudential policies, but micro and macro-prudential perspectives in order to be used as ingredients for a prudential policy which has to be somehow unified or has to take all those issues into account and be clear who is responsible for that and who has to say what to do with the capital, for example. And then, as a consequence of this perspective, it makes no sense to debate if you should have a macro-prudential authority and a micro-prudential authority or some kind of coordination between two authorities. I think that once conceptually you think that there has to be two perspectives feeding only one policy, you always will need only one authority. But there's something to debate. The last point, I take the excuse of your question related to virtual currencies and so on. Okay, we are in the middle of a huge technological dynamics in the world that is affecting all areas, not only in production, distribution, consumption, but also in human relationships. So the central banks are in the middle of that process too. And for example, there are at least two challenges that the central bank has to face right now. One is related to virtual currencies, cryptocurrencies, or currencies, digital currencies issued by central banks. Well, what's happening with Bitcoin and blah, 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 there's a lot to discuss. If we should use, for example, Bitcoins for international reserves or other transactions from the central bank's perspective. Well, when you have a currency which 1 year ago, it was $600 for one Bitcoin. 3 months ago, it was 5,000. 2 months ago, it was 3,000. And right now, it's like 15,000. Well, with this volatility, it's quite possible to be used as, for example, as a mean of stability, just almost by definition. You need international reserve. You need a lot of variables that had to contribute with stability. And by using a Bitcoin, for example, it would be impossible. And also because even, for example, the US in a dual currency economy as Uruguay, in which everything is more immediate because anybody can switch from pesos to dollars, dollars to pesos very easily. Even when the US dollar has this volatility, at the end of the day, you somehow understand why the US dollar evolves in the way it evolves. But with Bitcoins, at least we understand much less than that. So what is relevant with Bitcoin, in fact, is the underlying technology, the blockchain technology that I think that it has a huge potential for a lot of issues from monetary and also from the regulatory standpoint. I think that the digital currencies issued by central banks is something that we already have on the table, mainly in order to give more efficiency, less costly, and more transparent and more safe environment, reducing the cost of cash management, and also giving more citizen safety and transparency. So I think that the objectives for having digital currencies issued by the central banks is a humble, with humble objectives, goals, but it's something that we have to be on the table right now. In particular, here in Uruguay, we are in a pilot plan with issuing digital currency. For 6 months, we are trying to test from the technological standpoint and in order to begin to substitute some in a certain period the physical Uruguayan pesos with electronic or digital peso. It's the very same currency, no? It's the Uruguayan peso, but instead of being in paper or in metal, now you will be also having that in electronic form. As far as we know, it's the very first central bank in the world which are beginning this process, even when a lot of central banks are debating and discussing and considering this possibility. The very last point is that the other issue that is related to technology that is a huge challenge for central bankers and financial regulators is the fintech world. No, you have to take into account what's happening in the financial sector with fintechs, with electronic platforms. What do they actually do? How the traditional entities will adapt to that environment, or integrate, or compete, and cooperate, and from the regulator standpoint, we have to understand more deeply what they are doing, what they mean in terms of competition, innovation, but also safety, because the tension between innovation and safety in the financial sector is always there. The justification for financial regulation don't disappear because you have an electronic environment. So there's another challenge that we have to put more attention to understand what fintech means in terms of competition, cooperation, new products or new ways to deliver the very same products and so on, and what impact does it have in terms of the regulatory responsibilities, because representing and informed investors and preserving the systemic functioning of the financial system, those justifications are already present.
Thank you, Mario. So we learned that in the world there are a competition between Central Bank of Uruguay and Swedish Central Bank, because also the Swedish Central Bank are saying that they are considering the possibility to issue the e-krona.
Yeah. Let me tell you that yesterday I received an email from them, because some Swedish guys are coming here probably in February.
Okay, so the winner is
no,
it's not
a competition.
A lot of food for thought, really lot. Words are important. Capital control versus
capital flows management measures.
Macro versus macro. One more. Someone can explain me why we called the traditional open market operation we call quantitative easing. You can explain me later on. Thanks to the outstanding panelists, but warmly thanks to you, ladies and gentlemen, that have the patience and attention for us. Thank you very much indeed.
Yeah. Muy bien.